Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. And wow, what about Afterpay attracting a $39 billion takeover from the US-owned Square, and it's a share price which has really spiked today, up 19%. And the action helped Zip's share price. It rose over 8% today. So what does a local Afterpay investor do? We look at the big story and a number of new age companies that might be good value, including Money3, OpenPay, Paladin Energy, and Kogan.com. We'll do this with Adam Dawes of Shaw & Partners, Julia Lee of Berman Invest, Paul Rickard from the Switzer Report, and they've got Luke Smith from Ausbil, who thinks the iron ore price will fall. But does that mean that the BHP share price will fall? You must stick around for this interview. Well, that's the show. Let's kick off with Julia Lee from Berman Invest. Joining me now is Julia Lee from Berman Invest on a day when the market hit a record high.
Pete, what a day for the market, trading above 7,500 points for the first time ever. And of course, it follows hot on the heels of 10 consecutive months of gains for the ASX 200. And to give you an idea, if we see another gain this month in August, it'll be the 11th consecutive month of gains. And we haven't seen a run like that since 1942, 1943, when over in the US, government spending was 55% of GDP because they were coming out of that post-war period. And of course, people were coming out of the military, so unemployment was starting to rise. So, you know, an incredible run for the Australian market and an incredible day today.
Yeah, let's talk about Afterpay, because you've been a fan of Afterpay in your investing world.
Yeah, Afterpay, a takeover by Square. This is an interesting one. I think this is the biggest takeover on the Australian market ever, $39 billion. It is an all-scrip offer though, so it will be in terms of Square shares rather than a cash consideration. And the deal is expected to be completed in the first quarter of next year, so there's a bit of time to go. Today we did see Afterpay shares soaring 20% on the news, and for Afterpay shareholders it will mean that they get Square scrip, but it will be dual listed. The American depository receipts will be dual listed over here, so you'll be able to hold the shares in Australia but have access to one of the largest payment companies in the world.
Would you be a seller at this current price?
Look, I think a merged company makes sense. I'd probably be holding here because Afterpay is going to keep its index inclusion by the looks of it. So it means that Square will be included in the ASX 20 index instead, because of course Afterpay is one of Australia's 20 largest companies.
Okay. So it's an interesting one, isn't it? Because there was a bit of selling. I guess some people would thought, well, I don't want to hold a foreign company, but still it's an interesting development. Let's go on to some of the stocks I've been asked questions of recently in our Boom Doom Zoom show. And the first one is Money3.
Sure. Money3, this is basically car loans. So when you go to buy a car and you need to take it out a loan, that's really the core of what Money3 does. And I guess when you have a look at Money3, what they're looking at is a secured loan. The good news is that the outlook for cars at the moment is extremely strong. You know that if you went to try and buy a new car, there's a long wait. And if you were trying to buy a used car, the price has gone up substantially than what you would have paid 2 years ago. So a great outlook in terms of Money3. They're going to benefit from the rise people who want to be driving cars rather than catching public transport, but also a good team behind them as well. So look, I think Money3 is looking good here. It is a smaller company, but a combination of good management together with some of these tailwinds, especially in terms of car sales coming through, I think it's great for Money3.
Okay, let's go to the next one, OpenPay, OPY.
Yeah, I mean, OpenPay came out with its quarterly updates, and I think in terms of the quarter, they did see transactions up by 46% year on year. And while that all sounds great, we're sort of used to seeing sort of triple-digit number gains coming through from some of the other buy now, pay later companies. This is really a buy now, pay later company focused in on the US as well as the UK. The US and the UK are expected to make up about 2/3 of sales this year. But on the flip side, if you have a look at that buy now, pay later space, it's all about scale, and it's a race to get as big as possible, as quickly as possible. So Pete, I'd actually prefer to go with the big guns when it does come to buy now, pay later. And my preference would probably be to go with the biggest on the Australian market, and that's Afterpay.
Okay, and let's go to the final one, Paladin Energy.
Yeah, Paladin Energy has been around for a long time. So you're looking at uranium, and uranium's been one of these things in the past year. It's gone up, but it hasn't gone up as much as we've seen other commodities. For example, base metals is up around about 80% from the March lows last year. Iron ore prices have more than doubled. And then you look at uranium and it's up around about 20%. The good news is that uranium is expected to be in deficit. So whenever you look at commodities, when you're seeing limited supply and demand rising, that's actually a good scenario for commodities. So Paladin is a speculative one. There's not a lot of uranium companies which are listed on the Australian market, and it is hard to get exposure. But a speculative buy, I'd probably put a little bit of money here, given that uranium prices will likely increase over the next 12 to 18 months.
Yeah, I guess a worldwide economic boom will have a demand for that kind of resource, even though it's not fashionable and loved by the green movement. It's kind of an ironic resource, isn't it? Because it actually could help us use less fossil fuels, but the worries around nuclear energy are such that you just can't get many lovers out there.
Yeah, I think China's still building a lot of nuclear power plants, but of course, we've been through the experience of Fukushima over in Japan, which makes people a bit more weary. But of course, when we look at uranium, we use it in medical devices and equipment as well. So there is a medical use. But you're right, Pete, the main driver of uranium is through the power play. And it is a greener energy, although people are looking to other renewable sources as well, given the Fukushima experience over in Japan. But look, demand is still rising and supply is tight. So I think that bodes well for prices.
Final one, this is the one you like, and it kind of is surprising, Kogan.com.
I have to admit, Pete, I bought a couple of things from Kogan in the past week. I bought a steam mop, which is fantastic for cleaning my hard floors. They've never looked cleaner. And I've also bought a standing desk, which hopefully will arrive next week, so I can stand up while I'm working at home rather than sitting down. But look, I suspect many other people are in the same boat. I was speaking to a friend, and they're looking at one of those robot vacuum cleaner mops, and it looks like a lot of people may have been adding to their household appliances during this lockdown, or the mini waffle maker that's trending on TikTok at the moment. So look, Kogan, the last update was quite negative. They said they had too much inventory in the second half of the year, and that led to higher warehousing costs and of course trying to clear that inventory. But I'm guessing that given lockdown in July, August, and it looks like it might even be till October, November, that Kogan will be doing pretty well in this type of environment. So we started accumulating at $10.08 today. It finished the day at $10.40, and I think it's looking like good value at these levels.
All right, Julia, as always, great to see you, and let's hope your tips are right.
Thanks, Pete.
And that's Julia Lee from Berman Invest. And now it's time for Adam Dawes of Shaw & Partners, and he too is going to look at the Afterpay story. Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. Well, it's been a good day for the stock market when a lot of the pundits thought it could have been a negative one because of the spread of the coronavirus worldwide, particularly this Delta strain. So was it driven by overall market forces, or was it driven by the Afterpay takeover by Square? To answer these questions and more, we have Adam Dawes from Shaw and Partners. Adam, thanks for joining us.
Yeah, thank you very much, Peter. It's always a pleasure to be here. It's an interesting way our market finished or reacted today. Look, certainly came out of the gates pretty quickly as far as the banks doing well. Tech was doing well. Consumer discretionary was doing well. The miners were a little bit subdued, but that was really the only sort of negative that we saw in our market today. And certainly Afterpay really lifting everybody's hopes, potentially with more mergers and acquisitions that have been going on. And Afterpay contributed to about 16 to 17 points of the index today.
So why don't we just talk through, for people who may well be holding Afterpay shares, is Square, for example, buying the whole company? What's going to happen to people who are holding shares in Afterpay?
Yeah, so it's a merger. So it's both of these guys getting together. Jack Dorsey, which is Twitter, has created this new company called Square. This company is it's a very big acquisition that they're making for this, but they're basically going to be merging the two businesses together. And I think it's a natural fit for an online business being Afterpay, and for that sort of millennial side of things. For Square, which is more sort of tap, you see these little squares on the counters and things like that. It's just a tap-based machine. So putting them together, you've got your online and your physical delivery there going forward. Now, Afterpay has around about 16 million customers worldwide and has 100,000 merchants at the moment. If they do merge with Square, that gives them a huge reach, not just in the US, but a global reach. And I think that's what they're looking for. But for shareholders that hold Afterpay here in Australia, they'll either set up what is called a CDI, which is basically like a ResMed, where it will be traded on the Australian Stock Exchange as well as the US Stock Exchange. But I think over time, maybe in 24 months, they'll probably get rid of the Australian side of things, because when you're doing more than 60% of your business overseas, you still have to do the SEC filings, you still have to do all the paperwork for the US side of things, and Australia might just get left a little bit left behind. So for retail investors, you have to work out whether you want to hold international stock or not, and then you need to worry about currency and hedging and all these other things. So international is a bit tough for retail. That's why we saw a fair bit of selling coming into Afterpay today or this afternoon.
And there have been people just simply saying, I just want to take profits, I've done really well here, and I don't want to worry about what might happen in the future.
Yeah, absolutely. And it has been a fantastic story for Australia. And it's been a fantastic story globally for the buy now, pay later sector. I think we've really done really well on that. So I think it's a real testament to Australia's ingenuity.
Yeah, and one of the big question marks over companies like Afterpay and Zip was, well, are they going to be sort of taken, are they going to be sort of absorbed or beaten up by these big players? But they really are takeover targets, aren't they?
Well, very much so, because now you've got this consolidation in the space. Now you've got a lot of players, a lot of smaller players in the space, which are doing well, but are trying to find their own little niche inside of this buy now, pay later sector. And so, yeah, you're naturally going to have this consolidation, whether it's the bottom end or with Afterpay at the top end. There's always going to be that consolidation. Regulatory issues are going to always be there, but certainly, it's a fantastic result today.
So Zip did well today, and Zip was a pretty much a well-shorted stock. What's your take on that then?
Yeah, well, first of all, we want to get all the shorters out of Zip, Peter. So this is the first. We're gonna be a Harvey Norman. We're gonna send it to the shorters. We want to get them all out because it's a fantastic business. Look, I think Zip, if Afterpay does leave Australia and does go over to the US, that means Zip will be the number one player in the Australian market, and that's really fantastic. We have seen some selling in Zip today, but the stock's still up 8-9% today on the back of this, and I think it will continue to go on that, because we've also got Klarna in there. We know that they've taken a 3 to 4% stake on Zip. We know Amazon has a stake in also Zip as well. So there are some big players in this space, and there are some other players that will be wanting to muscle onto that action as well. And I think Zip is a really good target for that as well. But yeah, let's try and get rid of the shorters.
Do you think Amazon's big enough to take over Zip?
Yeah, I reckon they do all right. I reckon they do okay on that one.
That's a market joke. Okay, I asked you to look at a couple of stocks that we're asked questions of in our Boom Doom Zoom show for our Switzer Report subscribers, and one was a company called Money3, MNY. I didn't know much about it.
Yeah, look, what a difference a couple of years can make on this one. This one's actually a really good story. I own some in my super fund, so I've got to put it out there that I do own some. The company actually came and upgraded just a couple of weeks ago. They were looking for a net profit of around about 36 million. They've upgraded that to 38 million. Look, it's a really good business. It's a really good technology business. I'm sort of really comfortable with it. I think that these kinds of businesses will do well. I think they're in the sort of more automotive space, that kind of thing that they do, but positive momentum, upgrade, and confidence from the market. They've had a couple of acquisitions that they're bedding down at the moment, which seem to be working in the right space for them. So look, I'm really comfortable with this one, and I like recommending it to clients.
Okay. And what does it mainly do? What's its main profit center?
Yeah, so it's a subprime borrower in Australia, but specialise in secured loans for second-hand vehicles. Now, we know that second-hand vehicle market has gone absolutely ridiculous because it takes 6 months to get a new car delivered, and people need cars straight away sometimes, and that's why that second-hand car market is done. So non-secured loans for the automotive businesses, or automotive loans.
Let's go to the next one, OPY, Open Pay.
Well, here's a classic example of how the sector might consolidate in this smaller area or in this smaller side of things. We at Shaw & Partners have got a buy recommendation on this with a price target of $3.50. So look, it got hit today and has been continued to be hit. It's currently around about $1.17, $1.20. But we're seeing good momentum coming through in their verticals. Now, verticals isn't just retail, which is what Afterpay or Zip is in. This is also in healthcare, veterinary bills. There's so many other verticals, travel, that you could use the buy now, pay later side of things for them. So the key takeaway is the metrics are all strong. We're seeing good quarter-on-quarter growth. We really like this one. It's about their cash burn, and they're trying to sort of reduce that cash burn a bit. But with a $3.50 price target here at Shaw's, we've got a buy. I really like the story.
Okay, finally, Paladin Energy.
Someone must be looking at our research, Peter, because this one we also cover, and we've also got a buy on it as well. This one was the 56-cent price target. But Paladin is probably your biggest and best in our market for uranium. And uranium is one of those metals, or those, is it a metal? It has been left behind. This commodity.
A resource. In case your science and your geology knowledge isn't all that great, let's just call it a resource.
Resource. I think we should, because there will be people emailing you saying that guy is an idiot and he doesn't know what he's talking about. So Paladin is has started this Langer Heinrich mine in Namibia, and that's one of the biggest behind Cigar Lake in Canada for getting that restart. And we assume that'll be about 2023. Previously, they mothballed it because the uranium price wasn't doing any good or wasn't going anywhere. Now the uranium price is starting to get moving. I think Paladin is a high-risk stock in a high-risk sector, but if you're going to buy any one of those stocks, Paladin is the one, and we've got to buy it with a 56-cent price target.
And we should say, all three were mentioned today are not what you might call blue-chip core stocks, but they are ones that have potential. They might not be realised in the short term, but maybe in the long term they will. But it's a risky investment. Absolutely.
You must always seek professional advice before doing anything.
Yeah. Do you know any professionals who know stuff about stocks?
Maybe.
Adam Dawes, Shaw & Partners. Thanks for joining us.
Thank you. Have a great day.
And that was Adam Dawes from Shaw & Partners. And joining me now is Paul Rickard of the Switzer Report. Paul, thanks for joining us. Now, I'd love you to give me your take on this Afterpay story, because one thing you and I have often talked about, because you're always wondering what the potential was for Afterpay, and I always pose the question, I wonder if they're going to be taken over. We both kind of thought they were getting too big, but we've been surprised, haven't we?
Well, I think we've always given credit to Afterpay to what they've done, Peter, to be the category leader, not only in Australia, but also what they've done in the US. And you've got to give them credit for the price they've extracted. I mean, if you look at the multiple of gross profit or revenue, as they describe, it's something like about 77 times last year's gross profit and about 40 times the multiple of this year's. So that's a pretty big multiple of enterprise value to revenue. And congratulations to the team. So look, I'm not surprised that someone like Square is interested in their business. It's just that I think it's a great credit to the founders of the company.
Do you think if you were an investor, Paul, would you be inclined to sell out or stay in there and suspect that Square will actually help Afterpay become bigger and even better?
Well, look, I think it's a pretty full price. And I guess the trouble with that shareholders for Afterpay have, Peter, is that they're getting paid in share scrip, so they're going to get about 3/8 of a share of a Square share for every Afterpay share they own, and they've got some currency risk in the meantime because both the market and the exchange rate can change. So it's going to be some time till they actually cement the deal, and I guess that's why, compared to the nominal or the notional value of allegedly around about $126. We saw Afterpay fall today and closed around about 115. So it was pretty much a one-way trade. Lots of people selling out. I mean, I think Square's a great company led by Jack Dorsey. He's the guy behind Twitter. Certainly got a great product, had that in place in a number of markets. But you'd have to say it's pretty fully priced, and maybe the smart money is time to say, well, this is time to cash in the chips.
Yeah, and a lot of people selling also would-be fund managers who are going to take their profit and also then maybe sit and wait. And if the share price comes down, there might be a buyer again, because clearly, Square clearly rates Afterpay as being a pretty good company.
Well, you might recall, I mean, I have to be honest and say, Peter, I've been bearish on Afterpay, simply not because of the business it's doing and the way it's been set up, but just because of the pricing. Now, it shows that there's a price for everything, and Square's put money on the table in the form of script, not cash. And I guess you could say that the Square share price has also been pretty heady as well, and that allows them to do it. So great move on behalf of Square, but I think for a lot of the Afterpay shareholders that have been in from lower levels, this will come as a bit of a relief and a chance to take some money out of the market in that sense.
And do you think this actually adds more value to Zip as a second player in the market, Paul?
I think it does, Peter. I think Zip is positioned well in Australia and also in the US. I think that's, we saw a rally in Zip shares today. It is the number 2, at least locally, and I guess it's sort of up there in the US. It's not number 1. But look, it makes it, I guess, a more attractive target for, Square's competitors, other banks, also other payment companies like some of the big, people like Visa and MasterCard, who ultimately, you'd have to say that, the whole buy now, pay later is potentially a bit of a threat to its business.
Yeah, no doubt. Today in the Switzer report, you wrote about AGL, and a lot of people ask us about AGL. What's your bottom line conclusion, Paul?
Bottom line, Peter, I think it's probably in buy zone. Now, I've resisted writing about AGL and talking about AGL for months because it's been a steady decline. It's in the sort of AMP category in terms of share price performance. Back in early 2017, it was trading around $26, $27. The analysts were super bullish on the stock. On Friday, it closed at $7.23. So you've lost about 75% on that over the last 3 or 4 years. Basically been a one-way train down the whole period. So I'm always wary of the old, analogy about catching the falling knife, Peter. You wait till something bottoms, gets a bit of a base. Don't jump in the meantime. I think AGL might be a little bit different because I think the demerger it's pursuing is interesting. And as we've seen with demergers, they tend to have a fairly good track record. And so I think that may lend market support as it pursues the demerger over the next 12 months or so.
Okay. So if people want to read more about that, go to the Switzer report. Paul done a good analysis of that particular company. And before you go, coming up after you, I've got Luke Smith from Ausbil, who reckons that the iron ore price is going to come off the boil over the next year or so. What do you think of that suggestion? And what's your view on BHP if the iron ore price should go down?
Well, one thing I know, Peter, is that I'm yet to meet a really good commodity forecaster, commodity price forecaster. Doesn't matter whether they're an analyst, a broker, a fund manager, and I'm not bagging what he's got to say. So I really have almost given up trying to call where iron ore is. We all know it's in sort of it's historic highs, and it can't stay at this level forever. But that doesn't mean it's going to fall away quickly. Always been worried about more production coming on stream, particularly out of Brazilian producer Vale. So I guess if he's worried about that, I'm probably a little worried too. I do have a like BHP, not for iron ore, Peter. I do think it's a well-diversified mineral, a miner in terms of its copper and also its exposure to some other commodities. And so I think with BHP, you get more than iron ore, but if the iron ore price is to fall, that'll put some pressure on BHP, but not as much pressure as would put on the likes of Fortescue and Rio. So I actually like BHP in preference to those other two companies, simply think it's more diversified, has better assets. And I think there's less risk in BHP than perhaps owning either Rio or Fortescue.
Okay, Paul, thanks for that. And if people want to know what Luke Smith has to say about BHP and its share price in the future, stick with us and go to our next little interview with Luke Smith. Thanks, Paul. Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. Okay, so tell my viewers approximately where the iron ore price is now and where you see it over the next year.
Yeah, sure. Look, iron ore prices are roughly at $200 a tonne now at the moment. To my point, that's an exceptionally strong level, especially where they were a number of years ago at that $60 a tonne range. We certainly don't expect them to go back to that level at any time soon. We expect them to continue to moderate from these levels. But the interesting point about that, and it's something that we continue to reinforce, while we expect the iron ore price to correct from current levels, we continue to see consensus earnings forecast to be too conservative. That the street, that the sell side analysts on the street, continue to forecast an iron ore price that is far too weak for the environment that we're presenting. So we're presenting an iron ore price which is coming off, but an environment where earnings continue to be upgraded for the major Australian miners, supporting earnings, supporting cash flow, and ultimately, supporting capital returns that your listeners would obviously be focused on.
And do you guys believe that those kind of scenarios that the miners clearly have been, telling the market about?
From what perspective?
Well, are you expecting mining companies' earnings to still be strong, despite the fact that simultaneously iron ore prices will be on the slide?
Yeah. Look, we're obviously going through a super normal period at the moment. BHP and Rio's earnings are dominated by iron ore as a start, and so clearly that's driving extremely strong earnings. But the market, so sell side analysts are forecasting a significant decline in iron ore prices. So too aggressive a decline in earnings outlooks, and ultimately we see that moving up, and ultimately that's the key driver for share prices from our perspective. So it's a strange environment where we expect iron ore prices to moderate from current levels, but arguably the big Aussie miners could still outperform through that period as we see these earnings upgrades come through.
So I'm going to put you on the spot, Luke. You can't be a star and not be pressured, mate. So given that, and let's just say BHP share price is around, what's it now, 60?
Early 50s. Early 50s.
Early 50s, yeah. Actually, I'm way ahead of myself.
Yeah, you're 6 months forward.
I'm a big older of BHP. That's wishful thinking. All right. Now, and why I'm thinking 60, I know why 60 is in my head. Both Macquarie and Ord Minnett, they have a $60 price target on BHP. That's where the 60 came from. It's more around 50, right? 52, 53 or whatever. Other analysts have it falling, I guess, like you might. But where do you think the BHP share price will be in a year's time?
Oh, look, I could see a scenario where it's higher.
Right.
I won't outline a price number specifically for you, but look, it's a really positive backdrop for resources at the moment. Iron ore is one component, and I've touched on that, and that's a major driver for BHP's earnings, and ultimately, to my point, I still see earnings upgrades coming through from iron ore because the street remains too conservative, but there's more to BHP's business than just iron ore. Iron ore, you got met coal, you got petroleum. Both of those commodities have been, very strong, over the course of the last couple of months, but over the course of, this recovery that we've seen over the last 12 months, and on top of that, they've also got copper, and we see real opportunity in copper and likelihood that copper continues to strengthen as well. So one aspect is iron ore. Sure, we're expecting iron ore to fall. Arguably, though, that is the backbone for BHP, and then these other core commodities that we think are at the early stages of continue to support earnings and continuing to strengthen as well.
Do you think BHP is going to be helped by its commitment to being more ESG friendly, and therefore fund managers will possibly like them more today than they did, say, 2 or 3 years ago?
Yeah, look, there's a couple of ways to come at that question. All of the major sort of producers have looked to exit the less friendly sort of components of their portfolio, and thermal coal is the starting point. We've seen sort of exit by Rio Tinto and now an exit by BHP out of thermal coal, or looking to exit in the near term. Obviously some question marks as to whether or not petroleum sits within BHP on a longer term basis, and arguably it doesn't. It doesn't from a company standpoint, it doesn't from an investor standpoint, but then there's the aspects that feed into metals demand around decarbonisation. You cannot have decarbonisation without metals. It's as simple as that, and components of BHP's portfolio feed into decarbonisation. If it's copper and nickel, and the implications around demand for around electric vehicles. Most importantly, if it's potash, another project that they're looking to potentially move forward with as well, that feeds into some of these themes as well. So there's a couple of ways to answer that question. Ultimately, I think the portfolio mix will continue to improve over time, which will make it more investor friendly around fossil fuels, and then that theme around decarbonisation certainly isn't going away, and metals are core to it.
And what's your view on BHP's link to Tesla, a deal that was recently announced?
Yeah, I think it just reinforces that some of these base metals are core to the electric vehicle revolution. Nickel's not a major component of BHP's portfolio. It's a great headline. I think it reinforces the overall theme around electric vehicles, and it's real. The acceleration that we've seen in EV penetration, both in China and Europe last year around the green stimulus post-COVID, fed into really significant step up in EV penetration rates. That's great for base metals demand from an incremental standpoint. If it's copper and probably more importantly nickel, as you highlight with that Tesla deal with BHP, but it's even more important with these purer demand commodities that aren't as far removed and have such more materiality in terms of EV demand growth. Lithium, cobalt, graphite, manganese, important as well. But clearly, BHP doesn't have exposure to those commodities.
Yeah. So, and the point is also electronic vehicles use copper as well, which to me makes me think, well, copper historically is sort of like a demand global boom type resource. But if it's going to have a much stronger role in this sort of structural change in the car industry, that's going to be good for copper prices, I would have thought. And even a company like Oz Minerals that's pretty long on copper. Do you see it that way?
Yes, spot on, Peter. Let's start with demand backdrop. I sort of touched on China, but what we're seeing in the rest of the world, as we've seen a restock, and then the implications of monetary stimulus and then ultimately fiscal stimulus feeds into a really positive backdrop from a demand perspective for consumption-related commodities. Let's call it. Copper is one of those from our perspective. And then for the last decade, you've seen no investment or modest new investment in new copper mines as well. So you've got this backdrop for a commodity like copper where demand is accelerating and there's been a lack of investment in new supply. And then to your point, Peter, you've got the incremental demand drivers from decarbonisation, specifically electric vehicles, incrementally, more demand that feeds into an electric vehicle, but also the transmission and recharging facilities feeds into incremental demand as well. So a commodity that generally grows at GDP plus now has some significant turbocharge in terms of the outlook for it, and we expect it to continue to strengthen.
And that was Luke Smith from Osmill. Interesting take, wasn't it? That even though the iron ore price might be on the way down, BHP's profit and therefore its share price can go up. Interesting observation. That's the show for tonight. I'll see you on Thursday. Make sure you're there.